All right, now that we've learned how to find highs and lows on a chart and that liquidity may or may not be resting at those highs and lows, that brings up the next question. What is liquidity? And simply put, liquidity is orders going in and out of the markets. To someone like me, that makes sense, and that's how most people would explain it. But to a beginner trader, that may or may not just sound like a whole bunch of gibberish. So, let me break it down for you in a way you'll understand. We're going to use Pokemon cards here. Okay. Let's say you're Billy. Okay. Billy wants to buy a Pikachu Pokemon card because he thinks the price of that Pikachu Pokemon card is going to go up in the future. All right. Cool. He puts it out there. He states, hey, I want to buy a Pikachu Pokemon card, but I want to buy it for this price right over here, which is $25,201. I don't know what kind of Pikachu Pokemon card that is, but let's just roll with it. Then you got Jamie that wants to sell his Pikachu Pokemon card for whatever reason. And Jamie is like, hey, puts it out there. I want to sell my Pikachu Pokemon card for $25,201. Who wants to buy it off me? So naturally, when there's a buyer and a seller that are willing to trade, meaning one is willing to buy something at a certain price, they both agree on something, on a transaction at a certain price, that's a trade. And Billy stating, hey, I want to buy the card is an order going into the market. And Jamie stating, hey, I want to sell my card is also an order going into the market. Okay. Now, when they complete that transaction, that means the order is going out of the market, right? That the order is filled. Okay. That order doesn't exist anymore. Neither one of those orders exists anymore. Cool. So now you're wondering, okay, so I understand it now, but like that still doesn't explain anything. Why are highs and lows important when it comes to liquidity? I mean, I can buy the NQ contract at any point in time, and I can sell it at any point in time. No problem. Yeah, you can, but now let's put it into perspective. Let's level up a little bit. Let's say you have Jonathan, and he is a rich kid, okay? He has a lot of money. And Jonathan also thinks the price of the Pikachu Pokemon cards is going to go up in the future. But because Jonathan has a lot of money, he is willing to risk a lot of money. Instead of only buying one card, he wants to buy 5,000. Okay, so he puts his order in. He's like, hey, I want to buy 5,000 Pikachu Pokemon cards at $25,228 each. And yeah, sure. Is there going to be a handful of people that are willing to sell Jonathan a handful of Pokemon cards at that exact price? Yes. But if there isn't a reason for a lot of people to be selling their cards, he's going to eventually run out of buyers at that price point. Okay. So now he's left with two options. Either he sits on his hands and he accepts the fact that only part of his position is filled, or he can up the price that he is willing to pay per card to find newer buyers. Okay? Which, sure, when you're not dealing with too many cards, it may not seem like a big deal, but when you're dealing with a lot of cards, it adds up over time, right? And the price keeps rising and rising and rising and rising and rising, and eventually it gets so high to the point where it's not even worth it. You have a really bad average fill. The average price per card that you paid now all of a sudden is who knows how much, and you're not satisfied with that. That's not what we want. Okay. So what can you do? Well, you would have to wait for a reason that a lot of people may want to sell their a lot of Pokemon cards for, right? Whether that may be just the price of the Pokemon cards just getting high to the point where people are like, okay, hey, you know what? I am perfectly happy with selling it at this price. I made enough of a profit. I'm good. Or it could be the case of what I'm going to explain right now, which is the easier to understand scenario, I guess you could call it. Okay, let's say you had a lot of people holding cards, right? And they may have bought anywhere, literally anywhere. It doesn't matter, okay? Anywhere within this price point. Okay. So now that the price is going up, we're going up, we're going up, we're going up. Cool, everybody's happy, everybody's holding. And all of a sudden, what happens? People are starting to sell their cards. Okay. And price drops not only because people want to sell their cards for whatever reason it may be, but it's dropping dramatically because there isn't many people willing to buy those cards at that moment in time. Okay. So what happens? Price keeps dropping and dropping and dropping and dropping. Now, this is where these lows come in play, right? When we look at them in a chart. This, to the human brain, like I said, trading, with anything in terms of trading, only reason things work and things behave the way they do is because people make them behave the way they do. They use them that way, right? If nobody cared about lows or highs, it wouldn't matter, right? But because humans are humans, they think to themselves, they're like, okay, cool, maybe I bought right over here. All right, maybe I bought my card right over here. And this could be just one person. Well, I want to hold it until who knows where. Okay? I want to hold my card until price gets to whatever point. But if price per card gets below the lowest point from, when we had the lower point, let's say 3 weeks back, last 3 weeks ago, the price per Pokemon card dropped to $25,072 a card, right? And you're thinking to yourself, hey, you know what? If the price per each card gets below that, I'm not willing to risk it, right? I want to cut my losses. Even though I didn't, make a profit on it, I lost a little bit. I'm afraid, and that's the key word, afraid, that I'm going to lose more. Okay? So, what happens? The price per each card starts dropping. And it drops and it drops and it drops until it hits this level, this low, and it goes below the low. So now, again, like I said, because of psychology, because of human psychology, it's not just one person putting their stop loss at this low. It's a whole bunch of people putting their stop loss at this low. Meaning, a lot of people are like, yeah, I want to sell this right now, even if I'm selling it at a loss. So now if you're Jonathan and you're smart, right, instead of paying a hefty premium for your cards, you just wait for a level like that to get hit. For a reason, you're waiting for a reason for a lot of people to be willing to sell their cards. So what happens now? Now that you have all these people, thousands of people, herd mentality, selling their cards, well, now if you're like, hey, I want to buy 5,000 Pokemon cards at $25,080 or anything below that, people are more than happy to sell you theirs, right? There's a lot more people that are willing to sell Pokemon cards, and there's a lot more cards orders in the market. Okay, and that's how liquidity works. That's how it behaves and why it behaves the way it does. Okay, so now that you're that you're Jonathan, and not only are you rich, but you're also smart, and you know that this is just temporary, right? Well, you still expect the price of each card to go up. You understand that this is just a little pullback, okay? So you buy in all these cards, and there's more Jonathans like you, right? There's other rich kids that are smart, and they keep buying and buying and buying. And over time, as you can see, even though there's a lot of transactions happening, right? A lot of people are selling and a lot of people are buying. The price of the card isn't moving much. That's because it's a area or a point in price that has a lot of buyers and sellers. Okay, so prices kind of starting to consolidate a little bit, starting to stick to one area until one or the other take over. Okay, and as you can see, slowly over time, the value of each card goes up and up and up and up and up until people start seeing this again. Okay, and now what happens? People are like, now you have a lot of people that want to buy these cards, right? Because they see, oh, wait, the price of them is going up again. And you start seeing less people that want to sell their cards because why? Oh, hey, look, the price of these cards are going up again. So now the price of each card dramatically jumps up. It jumps up fast. Okay, because there's more buyers than sellers. So naturally they would have to pay a higher price if they want to buy a card. Okay. And that is what liquidity is, my friends. It's literally just people, transactions that are going in and out of the markets, right? There is liquidity everywhere, okay? But there isn't large amounts of liquidity everywhere, if that makes sense, right? Now, if you want to understand how it works in terms of trading, replace Billy with just you and I, Billy and Jamie with you and I, okay? We're regular people. You want to buy a regular amount of cards. And replace Jonathan, the rich smart kids, as institutions. So banks, hedge funds, big, who knows, maybe even just rich ass dudes that have a lot of money and don't care and are smart, right? Whatever it may be. Think of it that way. That's why liquidity is important, okay? Now, you may be wondering, okay, cool, I understand that, but I am not a rich billionaire or a hedge fund. I only want to put in 3 orders. I only want to buy 3 contracts at a time. I don't have the money for 5, 50, 100,000 contracts. Why does this apply to me? Does this apply to me? Well, yes, it does. Why? Because look what happens. Just because you can get your order filled anywhere, that doesn't mean it's the best place to put in an order. So if we're smart and we follow what the big dogs do, and we wait until a level where liquidity could be resting gets hit, okay? Here's where we kind of have a little bit of an advantage, right? We don't have to buy in right away. We're not, if we don't buy cards right over here below this level, it's not like it's going to be so hard for us to find cards to buy at a price that we want later on, because we're only buying 3 cards. Okay, so the advantage that gives us is we can actually wait and see how price reacts off of a certain level. Okay, right? That's why I said high or low, and that liquidity may be resting at that high or low, because sure, there may be liquidity, okay, but is it enough liquidity to drive price up again? Okay, and if it's not enough liquidity, well, then you're kind of screwed, because price is going to keep dropping. Okay, right? If you just have sellers come into the market from their stop positions, but you don't have buyers, then it's not a sweep of liquidity. It's a run on liquidity. Okay, a sweep on liquidity is when it comes in, taps it, gets past that level, picks up orders, and it goes back up. Vice versa for a high. A run on liquidity is when price comes to a level, but people still don't want to buy for whatever reason that may be. And it just continues. It completely disregards that level, that low. People are like, yeah, I don't care. Go, get lost. Okay. It is a lot more complicated than that. It's not just people willing to sell, or just people getting stopped out. I just wanted to make it as simple as possible. And I did it specifically with sell side draws on liquidity, because I didn't want to have to explain how shorting works, right? That's a topic for a completely different video, and quite frankly, I'm not as educated enough to comfortably be able to explain it to you, or confidently be able to explain it to you. So that's the premise of it, right? It goes for both ways. People get stopped out, people want to enter positions, people want to take profits, people want to reverse positions, whatever it may be. There's a lot of transactions at that level, right? Or could be a lot of transactions. Just because there is a lot of orders, that doesn't mean there's going to be a lot of transactions. Keep that in mind as well. Okay, because if there's no sellers, a lot of times, sometimes you'll notice you'll have like a huge spike. And I don't know how long you guys been trading for, but it's really annoying to see when your take profit, you have your take profit right here, and it's, you're like, maybe I can go lower, whatever, blah, blah, blah. Maybe put it down here. But I want to play it safe, because I don't know if price is going to reverse off of this low, right? And you put your take profit here, or your take profit here, and you're waiting, your take profit hit, you're getting edged, price is just kind of floating around this area. And as soon as it hits it, instead of, continue to float around and kind of do nothing, or even reverse, it just completely shoots down. That's because, why? You have more sellers than buyers in the market, right? That's how it works. And that's how liquidity works. like I said, the best part is we don't need our orders, like we don't have an issue with our orders getting filled. We don't have to make very concise decisions and planning on, oh, is price for sure gonna go up, right? Obviously, we want to have a good strong prediction, a valid prediction, but it doesn't need to be spot on because we don't need to risk it and see if price is going to end up reversing, because we can just buy later on when price actually shows signs of reversal. We don't have 5,000 orders to give. Banks and institutions do, so they have to take a little bit more of a risk. Here's the other kicker. We can actually use that to our advantage, right? If price ends up reversing off of a liquidity, that means there's a very good reason for that. These big institutions with lots of tools and lots of smart people at their disposal have already predicted, hey, we are most likely going to go up in price. Let's buy, right? Well, we don't have that, but what we have is the advantage of waiting a little bit and seeing how price reacts. And if it reacts positively, which means institutions are buying in on those orders, we can safely assume, hey, these people are bullish or these people are bearish. So we can trade with them, not against them. Okay. So I really hope that this gives you at least enough of a comprehensive what's the word I'm looking for? Understanding of what liquidity is. And there's just one last thing we got to cover. Okay. So obviously we see a lot of highs and a lot of lows on a chart because that's what a chart likes to do. It only moves off of liquidity. If there's no liquidity, price is not going to move. Cool. Now you may be wondering, okay, how do I know if a low or a high is a strong draw on liquidity? Well, we can either sit on our hands and wait, which is the safer option, okay? But there's also little kind of things that pinpoint whether there's a higher possibility for it to be a stronger draw or a weaker draw on liquidity, okay? And also, before we get into that, I actually forgot to mention, going back a step back, you hear me say draw on liquidity, meaning price is drawn to liquidity. And the reason for that is actually pretty simple, right? We can see it where? Let's find it on the chart. Let's find it on the chart. Hopefully, I don't know. I want to find a really good example for you guys. That's news. Fine, let's use this as an example, right? Over here. And again, it's purely psychological because people understand that price is drawn to liquidity. Okay. What happens? Okay, price goes up. It goes up, 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 it goes up. Until we hit this liquidity. And the reason why price is drawn to this liquidity is because that's where people predict that price may want to go. Okay, so if you have enough people predicting where price might want to go, naturally, you're going to either have more people buy or you're going to have more people sell. And it's naturally going to go up until it hits that level or go down until it hits that level, right? It's just psychology, human psychology. Hey, I have a feeling that this is going to be I feel like a lot of people are going to, put their orders here, and there's going to be a lot of liquidity here. I'm going to buy. I'm going to buy, and I'm going to buy, and I'm going to buy. And it's, even though we're all the way over here, and if it comes back down, you're kind of screwed. Well, that doesn't change the fact that you think that this is still a strong draw on liquidity, and we're really close to it. So you're like, all right, might as well. So there's buying pressure or selling pressure all the way up until the draw on liquidity, because that's literally where people think price is going to go. Now, identifying a strong or a weak draw on liquidity. Here's where it gets interesting. This is where time frames come into play a lot. Remember how we talked about higher time frames hold higher power. Okay. We're never looking for liquidity on the 1 minute time frame. It doesn't do anything, right? Why? Just because we have so much of it. It's very weak. Sure, could it work a little bit, but look at this, right? We're smashing right past these lows. We're smashing right past these lows. Maybe we're doing like a little bit of a retrace, but not a certain move up, okay? Same thing, 5 minute, 15 minute, 30 minute, okay? The higher the time frame, generally, that the liquidity, that the low or high is on, the stronger or the more powerful it may be. Okay, so what do I mean by this? Let's go on the hourly time frame. Okay, and let's go back down on the 30-minute time frame. Okay, let's go to the 30-minute time frame. Let's say this for example. Okay, what do we have here? We have a low. Wait, no, this is a bad example. Bear with me. Sorry. Okay, here. This is what I'm talking about, right? When we're mapping out liquidity, we're not actually looking in where the orders could be. There is tools for that, but we don't use that. Okay, let's say you're on the 30-minute. And this is obviously a high, okay? But if we go to the hourly, this is still a high. Wow, I'll be right back. Okay, wow, that actually took, okay, it didn't take longer than expected, but it wasn't actually that long. That was what I mean. It did take longer than expected, but I have a good example now. So we're on the 5-minute time frame. As we can see over here, we have a high, right? But here's the thing. If we go up on the 15-minute time frame or any other time frame above that, that high doesn't exist. Okay, so that means that's a low time frame high. Okay, because it is a low time frame high, it doesn't hold much power. And what happens? Boom, we smash right past it. No reaction. Okay. Now on the other hand, we have, let's go on to 4 hour. Oh, this is a really good one here. We have this low right here. Okay, this is considered a low. This is a 4 hour low. Okay, what happens to it now? Okay, let's scale down. Look at this. Price comes up, comes down into it, does some shenanigans, and boom. Let's find another example. High time frame. High or low? Here. Boom. Good example. That's a little steep. Oh, there you go. 4 hour high. What happens? Gets hit, Boom. Very, 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 very powerful draw on liquidity. Now it gets hit multiple times, but this first time we have a reaction off of that. Now we make a newer high, and this is still a 4-hour draw on liquidity right here. This is a new 4-hour draw. Okay. Boom. What happens? Okay, this one gets hit. What do? Completely shit the bed. Now, obviously, price is not going to react off of every single high and low. That's not how price works. That's why we need to figure out if something is a strong draw on liquidity or a weak draw on liquidity. Okay. Also, remember this little example I showed you? That I'm going to get into it in a little bit, where you see that, okay, technically, out of these 3 wicks, technically this is the hourly high right here. Okay. But this wick is higher than, did I just do that? Wow. Than this wick. Okay. And it stands out a little more. Well, this is technically not considered a hourly high. This is considered a 30-minute high, because if we go down to the 30-minute time frame, we can see the pattern. It's a high now because we have a bearish candle followed by, a bullish candle followed by a bearish candle. Now, just because it's a 30-minute high and it's not an hourly high, that doesn't mean it's not a strong draw, right? That doesn't mean it's not an important level, okay? If anything, it could still be an important level because it's very obvious on the hourly time frame. Hell, it's not obvious on the 4-hour, but it's very obvious on the hourly time frame. Same thing here, okay? Now, how do you determine whether it's a strong draw or a weak draw on liquidity? Well, how isolated is it? Okay, that's a decent way to determine, okay? And what I mean by that is there highs and lows near it? Is there a lot of highs and lows near it? Okay. So technically, this wouldn't be considered a very strong draw on liquidity. Why? Because, okay, we have another low not too far below it, and below that one we have another low not too far below it. Okay. That doesn't mean that it's not going to be a strong draw. It just means there's a possibility that it's not going to be a strong draw. Okay. But now, whereas, for example, this liquidity right here, or better yet, this one we were looking at, yeah. So notice how for a while, this is the highest point, okay? And there isn't nothing really higher than it that is anywhere near this price point. It's very isolated, okay? That means that it's most likely going to, the price is most likely going to react off of that draw, okay, that high, because it doesn't really have anything else to react off of. So if you're somebody going in putting take profits or stops, right? I mean, what else are you going to put them at? You don't have anything unless it's all the way up top here. That's way too far-fetched, okay? So then that will be considered a strong draw on liquidity. Another example of a strong draw on liquidity. Let's go on the 4-hour time frame. These are a little easier to spot because price is less, there's less noise. But look at this. This is a phenomenal example, right? we have this huge low right here. Okay. And it's very isolated from everything else. There isn't much above it, or at least close to it. There isn't much below it. At least that's relevant. These are very small. Okay. What happens? We make a huge move from this liquidity. I mean, from the bottom to the biggest top, that's 1,746 points. Okay. And this could be a good or a bad thing. Okay. It could be a good thing because if it's a very apparent low, there's a high probability that price is going to reverse off of it. But also, if you don't have much near it, well, then there are chances that there are odds that price won't actually hit that low. Okay, there's a good chance they won't hit it, and you don't really have anything near it to put your take profits at. Okay, what do I mean by that? Well, this is a really good example of it right here. Okay. Yeah. No. Give me a second. Okay, here, for example, this 4-hour low right over here. Okay. It is decently far away from any other low, from its closest low, which is this one up top right here. Now, the issue with that is, as you can see, exactly what happened here. There's a probability that this low won't actually get swept out. Okay, we won't come and trade down below this level, below this price. Why that's a problem? Well, the exact thing that makes it a high resistance draw on liquidity also makes it a point of liquidity that price is going to have a hard time getting to. Okay, because it's so isolated. Okay, price isn't really going to, there's a good chance price doesn't come all the way down to take it out. Okay, but here's the thing, if it does take it out, people see this, they're like, wow, price just took out this level right here. This is huge. For price to come down and take out this level, that means it is at a very good discount, I guess you could call it. It's at a good price. And look what happens. Funny enough, well, there's a bunch of other lows, but funny enough, even if we go on the daily time frame, this low right here gets taken out. Okay, you have to zoom out a lot here. What do? We come, sweep it, we're just chugging away orders. We're filling. See how price slows down? It doesn't really abruptly move up. It doesn't abruptly move down. People are trading here. There's a lot of transactions happening here. And then when all the orders are filled, when sellers get exhausted, meaning there isn't much sellers left, price proceeds to reverse. And it doesn't really go back to that level anymore. Okay. Whereas a low resistance draw on liquidity is something that is very likely to get hit. Okay. So usually that means liquidity that is stacked, that is close to each other. There's two reasons why it's likely to get hit. First of all, because the liquidities are very close to each other. And so naturally, if they're really close to each other, hey, people say, okay, I can wait a little bit longer, blah, 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 blah. Like this, for example, okay? this is considered a weak draw on liquidity. Sorry, no, because this is a bad example here. I'm the worst teacher. All right. Cool. We got it. We're locked in. Here, beautiful. You see how you have low right here, another low right here. We have two lows right here. Okay, they're really close to each other. They're not very significant. Price is going to have an easy time coming down to these lows. Okay, it's like, okay, yeah, let's just take them out. It's not too hard to get to them. Now, whereas with this last one, it's a little more iffy, right? It needs a little bit more of a reason to go all the way down here. Same thing with this one, right? But then again, if it's something, boom, boom, it all gets taken out. Usually, quote unquote, low resistance draws on liquidity come in a trend. Okay, so they're one, well, depending if it's buy or sell side. If it's highs, they're one below each other, like one after another. Okay, it's kind of like a downtrend. Same thing here. See, it's an uptrend of liquidity. You got this one, then you got this one, then you got this one, then you got this one. These are all low resistance draws on liquidity. This is extremely high because you don't really have much near it, okay? Now, the reason why I said this is a bad example is because these are relatively equal highs, okay? What does that mean? Well, that means that they're really close to each other. Really close to each other. Not just, like, okay, yeah, they're stacked. They are 10 points away from each other, if even. Relatively equal highs are extremely strong draws on liquidity. And equal highs, so let's say these two highs were at the exact same price, not a tick, not a point above or below each other, then they would be considered equal highs, and that is even stronger than relatively equal highs. The reason why they're strong, well, think about it, right? Price didn't break past this level here for a reason. Okay, there's something holding it up above here. So, what does that mean? That means this is a good level to buy in or to short. Okay, because there's something blocking price from going any further up. Now, once we actually go into this level, look what happens. We hit it and we actually shoot down a lot and pretty quickly. Now, does that necessarily mean it's going to make a huge move? No. That comes with context and price action and world events and everything along those lines. But it just means that it is more than likely, or these are more than likely going to get hit. And price is more than likely to react, at least somewhat, off of them. Another example of relatively equal highs that we had was today, right here. Boom. Boom. Cool. We had even more right here. Look at this. Boom. No. Whatever. That's, what did I just do? I just removed the wrong line. That's enough. 2. That's 4. Really extremely close to each other. What does that mean? That means there is something holding this up at this level, right? There's something supporting price that makes it not really want to go any further. So when we're getting close, right, and price action is not only giving us a reason to think that we're going to go up, but we're also decently close, we're within reach of these, they're more than likely going to get taken out, right? As long as we have adequate enough context and volume and pressure, buying pressure, which is honestly our edge in terms of liquidity. Context, like I mentioned before. Sure, can you just place orders based off of lows that are significant? Yeah. But then your entries, not only are your entries going to be maybe not the best, but you would also need to have very large stops to accommodate, because you don't know when price is going to reverse. Oftentimes, when when a point of liquidity gets hit, it doesn't just barely tap it and reverse up. It kind of likes to dip down below a little bit and trade within that area. So you would need to have your stops really big, which is bad for risk to reward, for risk management. And that's where all the other confluences come into play. But this is a very long video. I hope you guys learned everything. I hope you guys understand everything as best as you can. And if you have any questions, feel free to reach out. I'll see you guys in the next one.